Okay, hello everyone. Jamie Trull here. This is Power in Numbers Live for July. I'm currently live on YouTube. Typically, I'm also live on Facebook, but it looks like the Facebook connection is not working right now. So maybe we'll get it shared into Facebook if we can. But it is not connected, unfortunately. So wherever you are watching me from, say hi. This is July. So Power in Numbers, if you have not joined us for this is a live show. So I used to do lives every single week for years. And then we moved to creating more evergreen content that is for YouTube specifically. But I really missed kind of the live interaction and being able to talk about things that were really topical right now. And so that is why we created this show. So this is once a month on the last Wednesday of every month, typically. And we talk about news that small business owners need to know, to-dos, what we should be doing right now in our business. And also I take some of your questions at the end. So it's news, to-dos, and cues. So I want to jump into it, but before we get into it today, I have a few things I want to talk about. There are some new IRS things going on that do impact you or very likely will impact you that you should know about. So that's going to be what we're going to talk about at the top of the show. But before that, of course, we got to talk about our sponsor, OnPay. OnPay is our sponsor today. OnPay is the payroll company I actually switched to last year. Y'all, since I've been in business, I've actually used 3 different payroll providers. So I kind of love to switch up my software every so often, in part because I really like to compare various different software programs with one another and understand how they're different, how they're the same, so that I can help my audience decide what's right for them. I'll tell you, OnPay is super easy. I love their customer support is on it. It's probably been the one that has had the best customer support that I have been on. And my favorite thing about it too is that it's a fixed price per month, and it doesn't charge me more, and I don't have to be on a higher plan because I have employees in multiple states. So my entire team is remote. We're living in a remote world these days. And so that is one of the things. Here's my OnPay link if y'all are interested. Obviously, I have a bonus because I love to be able to negotiate better deals for y'all. But OnPay has been great. So I do love, with a remote team, some different payroll providers would charge me for every different state that they're in. My team is in, let's see, where are they? North Carolina, Texas, Minnesota, and Florida. And Tennessee. So we're all over the place. It would be quite expensive on other payroll providers, but not on OnPay, which is one of my favorite things about it. And just because we have employees in multiple states doesn't mean that we're a big business, right? We're still a very small business. There's still only 5 of us. And so it would be cost prohibitive to be on a payroll platform that would charge extra for all of those different states just because we're a remote business. And that's the way of the world these days. So anyway, check out OnPay. Use my link if you decide to switch. I actually switched in fall of last year, so it doesn't have to be the new year to switch. Or you can use it, let's say, if you're an S Corp and you need payroll for yourself. It's a great option for that. So definitely check that out. Okay. All right. Let's get into the meat, the good stuff. All right. So for the news section, the very first thing I wanted to talk about was the change in the mileage rate. And the IRS did something that it almost never does, or very, very infrequently does, which is change the mileage rate in the middle of the year. Typically, new mileage rates are set for January 1st, but especially in situations where the cost of fuel has gone up significantly, they will adjust it mid-year. So the last time they did this was 2022. That, I believe, was because of the Russia-Ukraine war starting, which increased the cost of fuel. Right now, we have Iran and the US, so that is also what is increasing the cost of fuel largely right now. So if you're curious to see more about this, here's the actual IRS press release about it. But it has gone up to 76 cents a mile. So it was 72.5 cents. And now we've gone up a full 3.5 cents starting July 1st of 2026. Now, this can sometimes throw us off a little bit when it comes to our mileage deductions, because now typically you just needed to know, okay, what was my mileage for the full year? How much of that was for business purposes when you're doing your taxes at the end of the year to get that deduction. However, in this case, you'll need to know kind of the pre July 1st of 2026 versus post July 1st of 2026, because there's two different mileage rates depending on when you drove. So that's something to be aware of. And if you reimburse, say, mileage for your employees, this is also something for you to be aware of, that this has changed. Okay. So just make sure that you are aware. Like I said, this really only happens, it's happened a handful of times. And it's typically been because of some big impetus. I think it's happened maybe 3 times in the last 25 years. So it is not typical, but it just goes to show that when fuel increases as much as it has over a short period of time, the IRS will take action to change those mileage rates. So be aware of this. I actually haven't heard this talked about very much. The last time this happened, I feel like it was everywhere. And this time I was actually surprised to find this out. I didn't know that it was happening. So you may not know that either. So 76 cents a mile. Holy cow. I looked back too, because I was curious to see, I think it was about 20 years ago, in about 20 years, it was 2005, I think, the rate was at 40 cents a mile. So we've almost doubled, just about doubled in 20 years on fuel costs. And I know that that's probably something we've seen, right? I don't know about you, but I started driving in, like the late 90s. That dates me a little bit, but late 90s. And it was $20 to fill up on gas, right? And now these days, I'm going to the gas pump and sometimes it's $70, $80, $90. It's crazy. Now I also have, a car that has a bigger gas tank. And thankfully I have a hybrid car. So that goes a little bit farther these days, but still I feel like it is not cheap to drive a car around here. Thankfully I'm home-based. That helps too. But I also have 2 kids that I'm basically a chauffeur for. So it does affect me as well. All right, so make sure you're getting your mileage deduction. Make sure you are tracking that mileage and know what was before, like the first half of the year versus the second half of the year, and that you're applying different reimbursements to that. Okay, so that's number 1. Another thing, the IRS has been busy. I guess, they've got a little bit of space now. They have been busy lately where they are now putting out a few different pronouncements. So another thing, and I'll actually bring this one up, is around IRS penalties. And this is actually a good thing, right? It's nice. The IRS is actually rolling out things that we like. That's not always how it works with them. So it's very exciting to be able to see that we are, they're making some positive changes. So this is one that I think is actually great. I'll put this up and could impact you. So this is on penalty relief. Okay. So typically what has been the case is there's been a process called first-time abatement. So let's say you end up owing it listed out here. Hopefully you guys can see this. I'll blow this up a little bit just to make it easier. Give me 1 second. Okay. So there used to be a process called first-time abatement, so that if it was the first time or the first time in a while that you had gotten a penalty for either failure to file, failure to pay, or failure to deposit, okay, all of those things will cause you to get some type of penalty. You could apply for a first-time abatement previously. But that used to be a process that most people didn't know about. You had to fill out some forms and it was very proactive. You had to claim it. And a lot of people didn't do this, right? Go figure. A lot of people just, paid the bill and didn't know that this was an option to be able to kind of contest and apply for first-time abatement. And so what's happening now is it becomes automatic. So if you qualify, right, and this happens to you, you don't have to file any forms. They're automatically going to waive that penalty for the first time. So let me show you what actually counts. Let's see. I think it says it somewhere in here. Okay, so the new automatic exemption from penalty, or AEP, that's what they're calling it, is a systemic administrative relief program expected to begin this summer. So that's right about now. AEP applies to eligible original returns beginning with tax year 2025 and 2026. So even though it's starting right now, it's going to be kind of like slightly retroactive back to 2025 and future tax periods. And they qualify, this is important, you qualify for this if you have a history of timely filing the return and paying any tax due in the 3 years prior or 12 consecutive quarters for quarterly returns. So if you've been on time for the last 3 years, you haven't had any issues, and this is the first time maybe you failed to file or failed to pay or didn't pay, in as much as you were supposed to pay in, right? This happens a lot as small business owners. Let's say you file an extension because, we've got a million things going on, and you find out later that, oh, shoot, I haven't paid in enough. And now because I didn't pay that amount that I was supposed to by April 15th, right? That now I'm getting a penalty for failure to pay assessed on that. In this case, if this is the first time that this has happened to you and you have been in good standing for the last 3 years, they are going to actually automatically give you penalty relief. Okay. I'm curious to see how this will look. Hopefully they tell people like, hey, we did this, because obviously that restarts the clock. So you can't do that every single year because you won't be in good standing. But if you have been in good standing, it at least gives a little bit of wiggle room. And I think that that's so necessary, because most of the time it's not, malicious. Most of the time people aren't not filing because they are deciding not to. They're just busy or forgot, or, some communication fell through the cracks with their accountant or whatever it was. It's not intentional. And in that way, you'll get an abatement. Now, there are still rules around if you really are intentionally, not paying your taxes, different rules will apply. So I've seen a lot of people recently, and I have various feelings about this, but talking about how they're there's a method of protest for various things. If you're unhappy with what's going on or where you feel like your money is going, there are people who are protesting paying their taxes. I think this is very risky. And as a CPA, I cannot recommend this. Of course, I understand, where people are coming from on this. But what I'm constantly shocked about is the amount of people that are comfortable saying this on the internet, like the amount of people that are literally putting it on the internet and commenting on, different posts saying that they're not going to pay their taxes. Let me tell you, if the IRS sees that and knows you didn't pay your taxes, this penalty abatement probably is not going to apply. So just remember, what you put on the internet is for all to see, and we should not be surprised if the IRS, the U.S. government, is aware of our public displays of those thoughts. That's just a general good rule, I would say. Don't assume whatever you post online nobody's going to see, because you never know. It's out there. So just think about that. Okay. So let's see. What's our next thing? So those are two good things coming from the IRS. We are increasing what our mileage rate is, yay, and what we can deduct related to the mileage we drive for business. And we now have automatic abatement, first-time abatement for people who have been compliant with their taxes. So less to worry about there. Now let's talk about some news that's not as exciting, at least from my perspective. It's not as exciting. We're going to talk about tariffs. We're talking about tariffs just really briefly, because this has been, if you've been following any of the tariff back and forth, it's really been actually, in some ways interesting to see how the courts and the government will sort of fight this out, right? So this is basically a fight over what authority does the executive, does the president have to be able to unilaterally, create tariffs without the support of Congress, right? And so that's been the fight. They did have here. I'll pull up the article about this here. There's a good article from investing.com on this, which hopefully it will actually, it might be gated. Let me see. It's not going to let me pull it up right now because I've utilized all of my free articles on investing.com. But if you have not, you can go check out the article yourself that talks about some new global tariffs that are going into effect. Ultimately, some tariffs were deemed that they could not, they pulled the Supreme Court basically said, no, you can't do that. And then they found another workaround, which will, again, probably be challenged. They're using another code section to put some of these new tariffs. I think it's, 10 to 12.5% on 60 different trading partners. So it's going to be interesting, again, to see what happens with all of this. There is a process. If you paid tariffs, if you are an importer, you have to be the one that directly paid the tariffs, though. There is a way to actually be able to, put in a request for a refund. I haven't heard of anybody actually getting these granted just yet. But because of the fact that it was overturned and determined to be unconstitutional, the way that those specific tariffs were put in place previously, theoretically, there is an avenue for those who are importers to be able to get a refund. More to come. I'll update you as I hear anything additional on that. I know, though, unfortunately, a lot of small business owners, we aren't the importer necessarily. We didn't pay the tariff directly, but our cost of goods did go up because the cost of importing went up. Or maybe it affected us in some way indirectly, cost of fuel, all kinds of things that have been going up across the board. So that's just something to be aware of. But tariffs are back. They never really went away, I guess, but they're back. They're still happening. And so, be on the lookout. It's really interesting because I had to, I got a tariff bill. I don't have a goods business at all. I got a tariff bill that was related to my son. We were actually down in the Caribbean islands for summer, and he left his Apple Watch down in the Caribbean islands. And I had to pay an exorbitant amount of euros in order to get this shipped back to us, but it was still cheaper than buying a new Apple Watch. So we had it shipped back to us. And then after paying this exorbitant amount to get it shipped back to us, I got a tariff bill, which was like shocking to me to receive this tariff bill because I didn't buy anything. So I'm sure it was not for a lot. It was for $7.50. I'll probably still go through the process of trying to contest it to say, hey, this wasn't like, I'm not reselling any of these goods. This was our Apple Watch that we left there, so I shouldn't have to pay import. This would have been something that previously would have fallen under the de minimis rules, meaning like small packages like this usually didn't have tariffs associated with them, but they got rid of the de minimis rules last year. So that is something now, even if it's just, one small item that you're purchasing, a shirt from the UK, right? You could get hit with a tariff bill that you did not expect. So I'll report back. I'll let you know how it goes in contesting that and where, if it's worth, it definitely won't be worth the $7.50, but I'm just kind of curious what that process looks like. So I'll try it out myself and I'll report back. Okay. So tariffs back, boo, not as fun. Let's see. Now, that kind of leads me to my next discussion, which is on inflation. And you all know that that's one of the big things that I am constantly looking at, because I did a Power Numbers Live that talked about there is a massive difference. We may not like feel it, or it doesn't feel that different to be at like, say, 2% inflation versus 3% inflation. There is a massive difference because of how compounding works. So if we stay at, an average of 2% over the long term versus an average of 3% over the long term, it is astronomically different in how quickly prices rise and how quickly, the cost of, I think about like this Coca-Cola bottle, right? Like the cost of this used to be like, I don't know, $1. Now I go and it's like $2.50, right? For a bottle of Coke, which is crazy. I worked for Coke, so I can say that. I know how this works, right? But it really, with CPI growth and everything, it really can change the landscape very quickly if on average we're averaging much higher, right? It just means instead of maybe, costs doubling in 20 years, they double in 10 years, which means they're quadrupling if you think about it in 20 years, right? So the compound interest works great when you're investing, right? When you're investing and you get the benefit of compound interest. When you're paying, it is not great, right? That's where you are having to now pay higher amounts for the same thing, and costs grow significantly. So I will say, though, on the good news side of things, it's kind of a good news, but on the good news side of things, we did see CPI go down a bit this month. So here is from the US Bureau of Labor Statistics. I put all of these various different links in the chat. But ultimately, you can see where we are at. So this actually breaks it down. I kind of like, it shows you month to month the changes. Hopefully y'all can see this okay. I know it's probably small if you're watching me on a mobile device, but ultimately, you can see that, this is kind of the change over time, right? So seasonally adjusted from the preceding month. So we had been going up, up, up. So from November to December, we went up 0.3. From January to, or from December to January, 0.2, right? We were up, up, up. From February to March, we were up almost a whole percentage point, then 0.6. So we have been just trending upwards on all items. You can actually see down here what's really driving most of this. This is interesting. Again, kind of going with what we talked about. Here's fuel oil, up 43 percentage points. Okay, holy cow. June, though, overall, we're down 0.4%. Yay! We're still at 3.5. I still don't like that. That's still relatively high compared to, where we have been previously and what the targets for inflation have been. We typically want to stay in the 2 to 2.5 range, so 3.5. While it's better than 4, or what it was last month, 3.9, it's still not great. And my prediction here, right? My prediction here, let's see what was really driving this. So a lot of this was energy costs going down. That's what really drove it. Your food costs, guess what? They still went up. So you're probably like, I didn't see that at the grocery store. Nope, you didn't, because food costs has continued to go up. But you can kind of see like what is driving most of this cost. So anyway, the reason I was saying, though, this is kind of like good news, but like we're down finally a little bit. We also have new tariffs coming in. And so that is likely to push us back up again. My guess is that we'll see between now and August, but at least between August and September, I'm predicting that we're going to see an increase again in inflation. So, more to come. I do think, one thing that's been interesting is typically we get guidance from the Fed on whether they expect to increase or decrease interest rates. We have some idea of what they're going to do. They basically said, we're not going to give you any guidance. You'll find out when we tell you. And I believe that in the last half of the year, they will, because of these inflation numbers, I think that they will go the route of increasing interest rates. That would be my guess, but we'll see. We'll see, what comes of that. That's their decision on, which route they go. But if you are, we are actually looking at and in the process of building a new house. It's going to take a while because we're going to be building, hopefully, what is our long-term, I hesitate to say forever home, but our long-term home, our family home that works for us. So it's going to be a little bit, but I'm watching mortgage rates very closely because of that, because we are locked in this house. And it's one of the things that has kept me from making any changes is that we have, I think our rate is 2.875 on this home. So it is very hard to make those moves. And especially if rates are going to be going up, that's not something I'm looking forward to. Now we have a while. It'll be next year before we're closing on this house. So I'm hoping we see rates come down, but I don't know that I see the indicators that would be allowing for that. So we're going to keep an eye on it. That's one of the things I like to kind of watch what's going on economically and bring it to you so that you're aware of what's happening and you can think about it from that perspective. You know what? I missed something. There's one more thing. There's actually one more piece of good news I forgot to bring up that I missed, and that is on SBA loan funding. So one of the things that just recently rolled out, and I'll put this announcement on screen as well, from the SBA is they have doubled the maximum loan amount that you can get through SBA loans. So that just rolled out. That came out July 7th. So you can see from the SBA, we'll put this link in there too. But now you can combine your 7A and 504 loans to double available capital. It used to be that your limit on both was 5 million. Now you can have 5 million on 7A and 5 million of 504. If you're not sure what those are, this talks about the differences between the 7A and the 504. The 7A tends to be a little bit more general. That's your that can be used for many different things. It might be working capital, might be a specific project that you're doing or acquisition that you're making. That's what you can do with the 7A. The 504 is really specific for like major fixed assets purchases, things like that. So now instead of being able to get 5 million total, you can get up to 10 million from the SBA. SBA loans typically are at much lower rates with much more favorable terms than you would find on, say going out into like the regular loan marketplace. And there can be some pretty stringent requirements for SBA loans, but I do think that that is the best way. I always say that quick cash is typically expensive cash. So if you need loans, right? Taking those little loans that are like, hey, get your cash a day sooner with, when you're transferring money or whatever, that actually tends to be quite expensive. You don't see it. It's kind of a hidden cost. It doesn't feel like a lot at the time, but if you do that regularly, that's actually going to be a pretty expensive cost of debt. And credit card debt is the worst. We know this from APY and everything, like what the cost of credit card debt is astronomical. I could go on for a long time about my thoughts about predatory credit card usages. But all that is to say that there are so many different platforms now that are like, hitting you when you log in, like, hey, you might log into your banking platform and they're like, hey, get access to this capital. Anything that is quick cash that doesn't require, say, putting in your P&L and proof of assets and things like that is probably going to be more expensive than going the route of taking the extra time to go and apply for, say, an SBA loan. That is going to have better rates for you almost always. So just something to know, like going through that extra time and effort may feel, like, well, wait a second, I can get this cash over here from, my banking platform, but you're probably going to be better served in the long run to actually go through the process of applying. It's going to take some time. You're going to have to get approved, all of those types of things versus cash that can be in your account by tomorrow, right? So it's one of those things where we have to trade convenience for the rates, and that's going to have a better long-term effect for us. Okay, that's it. So a little bit of a mixed bag, some good news, some bad news. Honestly, mostly good news, I would say, this month, which is great because I feel like I've been coming in here economically with a lot of like doom and gloom. But I think like there's some positive indicators right now. So we'll watch it, we'll see. And we'll report back as things change. All right, so let's move on to the next session for today. It's time for to-dos. It's July. If you're watching me, I'm very proud of you because most people I feel like in July are out, with their toes in the sand, maybe somewhere, maybe, right now my kids are home from summer still. There's an actual extra week of summer. Typically they'd be going back next week, but this year we have an extra week of summer. Yay. So we still have about a week and a half left. I'm making it through, but I am like craving, I don't know about y'all, but I'm craving just the routine. I tend to really try to lean into summer and just the craziness of it and the free flowing of it. But I'm starting to feel that pull towards normalcy and routine and a little bit more time and space to actually do some deep work. We have some fun things that we're cooking up here in the business. And I just really want to be able to have that time to really dedicate to it. But as of yet, that has not been the case. So another week and a half, I will make it. Hopefully y'all will make it as well. Some of you may have all the way into like September. I know depending on where you are, it may be a while before the kids are back in school, but I love having them home. I also love when they go back to school. Just saying, they fight a lot. So what do you do now? What do you do in July? I mean, there's just a couple of things that I was going to bring up. I think a few of them are now is a good time to resettle, right? You have the first 6 months of the year. If you have time, if this is not a busy time for your business, this might be a good time to make sure your P&L is caught up through at least the end of June, right? And be spending time assessing where you're at. Maybe go back to any goals that you set for yourself for the year and see like, hey, am I halfway to the goal? Am I more than halfway? Am I less than halfway? If I'm less than halfway, how can I maybe adjust such that I would still be able to meet my revenue and profit goals by the end of the year? What might you need to do? I think the kind of mid-year check-in is so critical for small business owners, and we often miss it. We often just fly on right past it and don't even think about it. And it's one of the best things that we can really do for our business. So first, take the time to get organized if things haven't been organized or you haven't caught up on bookkeeping. But then really what I care about is spend the time with your numbers, right? Look at your first 6 months of this year versus first 6 months of last year. I always say like, numbers in a vacuum, like just numbers on their own, don't really mean a lot, right? You can garner some things from it, but really the benefit comes in comparison. So if you go back to last year, or maybe you compare month to month, how did we do January, February, March, compare all of those months to see the trends that are happening. Are you trending up? Are you trending down? What might be going on behind the scenes? And how do you course correct if you need to, right? We can't course correct if we don't know we need to. So looking at our numbers mid-year is probably the best thing that you can be doing for your business right now. I'm a little biased as a numbers person, as a CFO, but I think that can prevent so much unnecessary hustle and work later if you take the time, even if it's just a couple hours, right? When things are a little bit slower, and focus in on your numbers and try to understand the story that they're telling you. That's what I would say my biggest kind of thing to do right now in July is. It's also time to start thinking about if you filed an extension, guess what? It's coming back, right? Like we're now walking into August. Depending on if you have an S Corp return that may be due as early as September 15th, or if you have a personal return that you extended, that's October 15th. Now is the time to be re-engaging with your accountant, your tax person, to make sure they have everything that they need so that you can get that filed in time. Let's not count on that first time abatement, right? Let's save that for later when we need it. And let's get back into thinking about our taxes if you are someone who has filed an extension this year. Let's see. And then also, like I said earlier, with this change in mileage rate that I talked about at the beginning of the show, with the mileage rate going from 72.5 cents for the first 6 months of this year, now the IRS jumping it to 76 cents a mile. Just make sure you're tracking your mileage and you have it tracked adequately where you know what was pre-July 1st versus post-July 1st. So usually we're just looking at the full year. This time we got to actually separate it and be doing those calculations separately. So just make sure you have a spreadsheet or you're using a tool that is helping you do that. Again, that's a great thing. If you haven't recorded some of your mileage and you know you need to do that, great. Go ahead and do it now for the first 6 months. Get as caught up as you can so that walking into the second half, of the year, at least once you get to January, even if things kind of the wheels fall off, you're not now having to go back to, the beginning of the year. You now know, okay, the first 6 months is good. I have everything in there. It's reconciled. We're good to go. I know where we're at. I've looked at my numbers. I've, made some calls on things we might need to adjust. And then you can walk into the second half of the year eyes wide open. So this is a great time to reassess. We think about it when it's December and January, right? Because there's a very clear, it feels like a very clear beginning of something new, like end of something, beginning of something. But I like this time period as well because, and maybe it's just because I'm used to the school year mentality, both being a student myself back in the day, but also now with kids, I tend to see July, August the same way. Like this is a transition. So let's kind of prepare ourselves well. Let's start planning for the next half of the year and spend that time looking back to see where we've been as well. So those are the to-dos for July of 2026. Let's see, what else do we have? Now let's move on to the last section today. All right, now we do have a way to submit questions. If you want your question answered live, you actually have a pretty good shot at getting your question answered live. We do get questions in, but it's a little haphazard. So some months we have a bunch of them. Some months we don't have a lot. We only have one this month. So it's a great way to do it. I'll have my team put into the chat how you can submit your questions, whether you're watching me on YouTube or on Facebook. We just have you basically subscribe to our newsletter, and then it'll give you the option to be able to put in a question for me to answer live. So today we're going to talk about QuickBooks, because that is what we got. QuickBooks Payroll, actually, because we got a question from Chris, who was an FFF star. For those of you who know Financial Fitness Formula, that was my signature program. We've since retired it. However, I'm just going to tease real quick. We have some fun stuff coming up. So watch us for 2027. We have some amazing, exciting new things coming out. But Financial Fitness Formula was my program to help people be the CFO of their own business. And Chris was an all-star in that. So it was fun to see her name come through. And I'm going to put in her question here because it's a really good one. And here's how you submit your questions. So if you're on YouTube, just go to jamietrull.com/YouTube. If you're on Facebook or anywhere else, jamietrull.com/newsletter. Okay. So here is Chris's question. All right. So Chris says, can you talk about the new changes where QuickBooks, and this is QuickBooks Payroll specifically, is taking the federal tax money out at the time of payroll processing and placing that money into a holding account? QuickBooks then makes the tax payment on behalf of the business using the money from the holding account. Why is this advantageous to me? Good question. It just seems like it is a way for QuickBooks to have my money and earn interest on it in the floating account. Okay. All right. This is great. And I love this. If you don't know what it is, here is kind of the discussion of what this change is. And I'll pull it up really quickly too, just so that you know, if you're on QuickBooks Payroll. If you're not on QuickBooks Payroll, this won't apply to you. But if you are on QuickBooks Payroll, which a lot of people who use QuickBooks are, which makes sense, right? Let's see. You don't have to be. You can use QuickBooks and use a different payroll system for sure, like OnPay. But this is for those who are on QuickBooks Payroll. So here's what she is talking about, and I'll take this down. So this talks about what's changing, and I'll blow this up a little. Okay, so this is talking about what is changing. And so this started July 1st of 2026. For all customers, QuickBooks Workforce will automatically pay and file taxes that have been set up. There will be no manually submitting tax payments. So if you were manually doing this, there was an option to manually pay in your taxes. If you were doing that manually, that option is going away. It's all going to be automated, and it's going to be automated where the taxes are going to come out at the same time you run your payroll. So they're going to take that, they're going to put it in a holding account, and then when those taxes are due, they're going to remit them. And we're talking about employer taxes, Social Security, Medicare, any kind of employer and employee side taxes. So you can there's a video here if you want to learn more, and we've posted this down below. If you've just recently signed up, you probably already had this. But here's kind of how it works, right? And you need to make sure that you have your tax set up. That's one thing that I have said. Let's see, for customers who have not completed tax setup, QuickBooks will not be able to pay you and file your taxes automatically until setup is complete. Late completion may disrupt your payroll. So if this is you and you have not taken action, if you have QuickBooks Payroll and you're not sure, you want to go check and make sure that your tax setup is complete for this. Now, to your question, and so here's why they say they're making this change, okay? This update helps streamline payroll tax management by reducing the need to track deadlines and complete filings manually. With more automation built into payroll, accountants and businesses can spend less time on administrative tasks and more time focusing on their client and business priorities while maintaining confidence in accurate and timely tax handling. So from what they're at least saying publicly, right? They are saying, we're doing this to make your life easier and to make administration easier. They're also saying that they're doing it I've seen, in other places in here, it talks about how they're doing it to prevent insufficient funds, because when those tax payments are happening after the payroll run, it's more likely that you're going to run into more insufficient funds notifications where people don't have those if they haven't been set aside at time of running payroll. I will say, Chris, your inclination is correct. They probably are making interest on that in the interim. I would almost guarantee if they're holding your money, your deposits, they're likely making money on that in the interim. However, I will say it actually is more the norm than what QuickBooks was doing. What they were doing, like the norm with most current payroll providers is, and what I do with OnPay and with all three, like I said, I've had 3 different payroll providers in the last couple of years. All 3 of them, none of them were QuickBooks Payroll. I don't like QuickBooks Payroll. That's just me though. But all 3 of them did it the way that QuickBooks is now going to be doing it, where they would ultimately set that money aside at the time of payroll, and then they would remit the taxes later. So there wasn't an extra step to be done. There wasn't another pulling of money out of my account later on. It all came out at that tax time or at that payroll run time. For me, I actually prefer it because it does make life a little bit easier, but it can impact cash flows, especially right when they make that adjustment. You need to think about it from a cash flow perspective and how that impacts your flow of cash, because there will be, especially that first time, there will be an adjustment. After that, it'll kind of get onto a cadence, but it definitely is something to consider with the timing of your cash and to make sure that you're prepared for that change. But I will say it is pretty normal in the industry to do that, where it's all coming up, up at the time of payroll run. QuickBooks Payroll, I actually didn't even realize that they were still doing it that way, where you could make manual payments, but most of the newer payroll platforms out there already have this as their standard procedure. So just something to think about. There may be other ones. I can do some research and see if there are other ones that don't do this. I'm sure there are. But in the world where everything's getting so much more automated, it doesn't surprise me that they're moving in this direction. But you're right. They're probably making interest on your money. Because, that's how it goes with these companies. Okay, that's it for me today. I will put back up here. Let's see. Again, if you're looking for a new payroll provider, this is a good segue. Now, again, they still use the same process, but if you're just tired of using QuickBooks Payroll or don't like the customer service or whatever it is, OnPay is fabulous. I love it. It's been great for me, and they have great customer service. And I haven't had any issues since moving to it last year. So just a good thing to know, and always use my partner links because I always negotiate better deals than you can find anywhere else on them. So if you're wondering if I ever have a partner deal for something, just type in jamietrull.com/QuickBooks, jamietrull.com/0, jamietrull.com/Gusto, jamietrull.com/OnPay. You'll be able to find it, or you can go to our website. We have a deals page on our website that gives you all the deals that we've negotiated on various different software programs that business owners need to help them manage the financial element of their business. So specifically around business banking, payroll, and accounting software, those are really that's our bread and butter. So before signing up, definitely make sure to check our page. All right, everyone, y'all are awesome. Have a wonderful July. I hope to see you again next month. We'll be like a month into my kids being back in school, which is great. So best of luck to everybody. Stay cool, and I'll see you next time. Bye for now.